And we are live. Hello, everyone. Thank you so much for joining us for the third episode of Monetary Forces, a joint project between Izabella Cummings and myself, in which we look at the intersection of technology and finance that we both find fascinating. Not only the intersection, but also how it is changing global finance and the society that we live in. Izabella focuses on this in her two newsletters, The Peg and The Blind Spot. If you're not a subscriber, big recommend. I write the Crypto is Macro Now newsletter. Izabella is, as you know, an expert in monetary forces, a household name in traditional finance circles, and I've been focusing for many years on the crypto macro geopolitical angle. So we're circling the same intersection. That's why we decided to do this project together, where we pool our interests, we pick at them, we go deeper than the AI summaries would give you. And we also ask for feedback from you. If there's any topics you'd like us to cover, do please let us know. Now, this is a pilot series. It's weekly for now. It's clunky. It's Substack Live. We're still working on distribution. There will be mistakes like last week, for instance, where I totally messed up on the sound and Izabella was very gracious. Thank you for everyone who stuck with us through that. You are much appreciated. I won't make the same mistake again. I'll make different ones next time, I promise. So again, we're figuring this out as we go along, but one thing we are doing is having fun talking about the big changes that are affecting the markets that we swim in. So the format is we'll go through very briefly, and this is hard for us because we find this so fascinating, but we will try to be brief, 3 headlines that we think illustrate bigger picture changes that we're seeing. And then one of us will take it in turns. We'll dig deep into a paper and extract the insights that the summaries won't give you, that mainstream coverage won't give you, and that, again, add texture to the transformation that we're seeing. And this week, it's Isabella's turn. She's got some interesting stuff to say about unified ledgers and the impact on tokenization. Isabella, did I leave anything out there?
No, I think you've done a great job, and don't be so hard on yourself about last week. And I'm sure, it just makes us appear more authentic, I
More
hope.
authentic, yes.
Yeah.
Mortifying, sure, but definitely more authentic. And it's not like, you and I have never done this kind of thing before. You'd think, anyway, I would have thought I would have been better at it. But we live and learn. So thank you all for being here. Now, let's dive right in because we don't want to go too over time. We have a hard close. Obviously, one of the headlines we have to bring up is the launch or the unveiling, not the launch, the unveiling of OpenUSD, OUSD. Isabel, do you want me to set up the background before you jump in with the
Go ahead.
craziness a
Yeah.
little?
Go present the background. I think, mean, I'll just tee you up and say I don't think I saw it coming. My only reflection before you even explain what it is it for a project that big, it's amazing how they kept it under wraps.
Indeed. Also, for a project that big, it's amazing that the press release was handled so badly. But we'll get into this. First of all, what are we talking about? This was last Tuesday. We heard for the first time from Open Standard. This is a new stablecoin initiative led by Zach Abrams, the co-founder and CEO of Bridge, which was the stablecoin platform acquired by Stripe last year for just over $1 billion. Back then, that certainly caused ripples in the ecosystem. $1 billion. This was even before we got the institutionalization we're getting now. Anyways, Open Standard is launching a stablecoin called OUSD. It has over 140 partners, according to the press release, already signed up to use it. Now, the list is a who's who of traditional finance and tech and fintech. Stripe, Visa, MasterCard, Amex, Google, Shopify, Standard Chartered, BNY, BlackRock,
I'm impressed
Mercado
you've
Libre, DoorDash.
memorized that many.
No, I mean, seriously, it really is absolutely everyone. Only, and so the distribution power in that list was what really jaws dropped around the ecosystem. But then it turned out that several of the partners named denied having signed any partnership agreement, which of course casts doubt on the rest of the list. And one of my particular peeves, especially from the days I was working at CoinDesk, is when people use a press release as big marketing. Obviously, press releases are marketing, but at least make sure they're accurate. The number of times we saw very frothy press releases only to never hear from the participants again. Obviously, given the caliber of the people involved here, this is going to be a real project, and we're going to talk a bit about what that means for the ecosystem. But dang, did they flub this press release. Omid Malikan has a great phrase for it called proof of press release, which is basically all that we have to go on. And I actually did a word count. There were more words in the list of partners than there were in the rest of the press release describing what OUSD actually does. But I'll briefly mention the 3 design principles we were given, and then I want to get your take on that, Izabella. Design principle number 1, collaborative governance. All of the partners apparently have a seat on the board, which sounds somewhat unwieldy. Anyone with experience with consortium knows that that's going to be difficult. Second, seamless conversion, no burn or no minting and redemption fees. And this is actually a big deal because this makes the conversion smoother, more money-like. And then the third is revenue sharing. All of the partners share the revenue from the reserves, the interest on the reserves. The press release doesn't specify how that sharing will be calculated. Is it from balances? In which case, how do the partners incentivize stablecoins to just sit there and not move? Anyway, it's all very, very strange. Isabel, what was your take?
Oh, well, first of all, it's not that surprising. I've been kind of anticipating a big industry-led, multilateral kind of approach since Libra got shot down, because I didn't think they would just disappear. And I think some of the same names have reappeared here. So it is a little bit of Libra 2.0, albeit, as you've already said, under the Stripe umbrella this time. And, the waiving of the fees and all that, not surprising either. But the immediate metaphor that came to my mind is is that scene. I don't know if you are all fans of The Wire or not, but if you're, The Godfather also applies, which is this sort of moment when the rival drug cartels realize that actually killing each other over sort of their drug related rents on street corners no longer makes sense because everyone loses in that environment. So it's time to club together. And in The Wire, there's a famous scene where they all come together to form the New Day Co-op, which is again an alliance where they all basically agree to share rents and waive each other's kind of fees, and then they help each other out because it's better to organize on that front than to kill each other. The same happens in The Godfather. So I feel like it's a natural kind of rite of passage in all mechanisms like this, where there is a natural monopoly effect, where if anything that diminishes from the natural monopoly undermines the network effects, and therefore there is a genuine kind of requirement even to have a single operator. But how do you determine who that is? And you don't want it to be necessarily just, someone who's a first mover and never innovates again. So there is a sort of logic to it. And obviously we've seen lots of different consortia attempts with the whole kind of blockchain world for many years. And the problem is with all of these that eventually they all fail because they're usually a coming together of different factions that actually really hate each other, don't like each other's values, and getting along is much harder than anybody ever appreciated. Just look at the BRICS as a venture, as another equivalent. So that's what really came to mind. This is easier said than done. It's all fantastic if they can get along, but in practice, it's very difficult. The only real example of this working like in a really big way is obviously Visa and MasterCard. Like they are the ones that really pioneered this approach, and I think have implemented it perfectly, because obviously the banks own Visa and MasterCard respectively, according to different equity shares. But it's all based around a kind of conventional capital structure and equity ownership. Whereas here we're going to be talking about, I presume, we don't know. This is the other weird thing about it. Immediately when they issued it, I said to Noelle, I said, well, you should definitely do this as the white paper that, or we always want to read something properly for this show. And I thought, well, we'll have to read the white paper. But then I started looking for the white paper, and there was no white paper to be found, which I just thought was hilarious. So What are the details? We're still we still have to find out. But I suspect, as ever, these things are easier, constructed in theory than done in practice. And of course, Circle's CEO has already put out a few kind of have a go if you think you're hard enough comments. I don't,
Bring it.
it's
Bring
not
it.
that easy creating network effects. What do you think, Noelle?
I think you're totally right. It's the consortia part that first absolutely stunned me. There are other consortia. You mentioned a few that work. Zell is an example of another one, but they are consortia of aligned entities that collectively benefit. This is a mishmash of very big names that have very different priorities. You've got payments networks, you've got banks, you've got fund managers, you've got such an array of priorities in there that what they're going to get on a Zoom call every month and agree on the direction they want the network to take. I'm also frustrated by the lack of information and just how the economics will work. We gather open standard will be paid a fee, but does that scale with size? What are the incentives there? And coming down to the how does the revenue get distributed? Again, what's the incentives to keep balances growing? It sounds like it is a good idea that has not yet had enough thought put into how it is actually going to work. And as for the 140 partners, we know of several that have said, we never agreed to anything. And I think, much like Libra that you brought up, we're probably going to see some regulatory pushback. There are some very big European names on the list, like Adyen and I forget a couple of the others. Klarna is another one. And we can imagine the ECB absolutely having conniptions over this, given how panicked they are about the prevalence of US stable coins potentially in the European economy. So I can imagine the ECB just might get on the phone to the CEOs of these companies and say, you really don't want to do this, trust us. I have no idea. Much like with Libra, there were a lot of defections once the regulators got on the phone and said, you really don't want to do this. And sure enough, nobody back then wanted to incur extra attention. Now the regulatory environment is very different, especially in the US, but not so much in the Europe and other jurisdictions just yet. So early days, frustrating press release, especially frustrating that even given all of the drama that has transpired since it came out, Open Standard has said nothing at all.
I guess it's wait and see. Not for this time because I think we've got other things to move on to, but I think it raises really interesting questions about how revenue is already being split and whether we can assume that the heady days of sort of Tether like windfalls are ever going to be replicated again. I think, if anything, OpenUSD implies that those days are long gone and that the system is innovating around that. But
Yeah.
we will definitely revisit this topic as we get more paperwork.
Assuming we do, eagerly awaiting that. And before we move on, I'm particularly taken by the sign of maturity, but the shift in the narrative. Stablecoins a few years ago, 6 years ago, they were a product. We had USDT, we had USDC. They were a product we used, and then we got stablecoins as a service. Especially, that was triggered basically by the acquisition of Bridge by Stripe. Stablecoins as a service, a lot of white labels, and now I think we're moving into the narrative of stablecoins as infrastructure. Which sort of brings us segues into the next topic we briefly want to talk about, and that is Robinhood has launched its blockchain. It is now live. Robinhood chain is live, and we're not going to get into the details of the impact on market structure here, how it works, etc., other than to highlight that this is a total departure from the traditional market structure that regulators are used to and that even users have grown to know and love. We have market participants, market infrastructure participants, launching their own chains. Now, you don't get that in traditional finance. We have Robinhood now has its own chain live. Coinbase has Base. Kraken has Inc. Circle is launching Arc. We have fragmented mosaic of rails on which tokenized assets can move. Again, sounds chaotic, but at the same time, you can understand the incentives. You have market infrastructure participants that want customization. They want to control the entire stack. Whereas, again, we can't imagine NASDAQ or NYSE wanting to build their own rails. They use the public good rails that assets and settlement and everything already run on. This is a fascinating departure that regulators have not even started to really get their heads around yet.
what do you think is like? I haven't looked deeply at this story myself. So what is their objective? What are they trying? What do they think their own blockchain chain will achieve in terms of their own offering?
Yeah, especially given how much easier it would be just to use one of the existing public networks with perhaps some privacy and compliance layers on top. But the main reason is, well, control. They want the customization. They want to control the entire stack. And there's also the revenue. Revenue is important. Robinhood are going to be earning the transaction fees on their chain. There's some revenue sharing with Arbitrum, which is the underlying technology, I believe, but they'll be earning the bulk of the revenues because they control the transaction sequencing. There's that. There's also the owning the community. It's an open network. It's anyone can build on it who wants to. Obviously, there are some hoops you have to hop through, but it's open. And if you have the developers, the users will follow. Users do tend to follow developers. And you also have, and this I think is actually fascinating, the branding. It's not so much Robinhood chain, it's that this is just now part of Robinhood. Rather than Robinhood using Ethereum or Arbitrum, this is Robinhood and a chain is part of it. It's almost like abstracting the blockchain into the background. We now have an entirely new market ecosystem and it just works. Blockchain is no longer the go-to phrase.
But presumably that means they have to issue their own coin that underpins the chain. And so what I'm wondering is this a kind of attempt to create a decentralized exchange for that? Like, obviously they're known for operating effectively not an exchange, but a platform, a trading platform. So it makes sense, I guess, if they're wanting to kind of put a toe into the world of decentralized finance, no?
I think in a way that, I mean, that's a fascinating question coming at it from a different angle. They are very interested in decentralized finance, but they don't feel the need to build it. Uniswap launched with them, for instance. Alpha will be part of it. I'm sure all of the big decentralized names will be part of it. And so what Robinhood is trying to do, in my opinion, is sketch out the marketplace of tomorrow, which is centralized, decentralized, lending, trading, custody, everything you want in one place. And the big difference also between them owning the chain is that everything they do will move on that chain. And that gives synergies for the tokenization, which can then be tokenized assets used as collateral in some of the decentralized lending pools and all paid for by their stablecoin. They have a stablecoin. It's a collective stablecoin, USD Global, I believe, issued by Paxos. So it's a one-stop shop, sort of like the Alibaba apps, for instance, but leveraging blockchain efficiencies and flexibility. And I think they aim to get that big.
It just reminds me a lot of Hyperliquid and how, Hyperliquid has their own token, and they were I don't know if they did, or I can't remember. They were dabbling with all sorts of grandiose plans.
Yes, they have their own chain as well.
And they have their own chain, exactly. So that's what I was wondering. But anyway, it's really interesting to watch. Definitely something to keep an eye on.
Yeah, again, market infrastructure, launching their own infrastructure. I think that is absolutely fascinating. And this does sort of tie into the third brief headline we wanted to mention, which is, again, with everything on the same chain, you would think that there would be liquidity and synergies. This is not necessarily the case when it comes to tokenized deposits. I prefer to call them deposit tokens, but you all know what I mean. Tokenized deposits are generally, again, if you're not familiar, a bank will issue a token backed by a client's deposits, and the token can move freely within the bank's ecosystem, within the walled garden, because it complies with the KYC requirements, etc. But that's fairly limited. JP Morgan used this system, Citi does as well, and they're huge, so it's not so limited for them. But when it comes to the smaller banks interested in issuing tokenized deposits or deposit tokens, then again, scale becomes a problem. There are some interesting solutions that are appearing, and we got some news on one of these last week, and this is the Carry Network. This is a purpose-built platform to generate deposit token liquidity, and there are two fascinating aspects to this. One is that it is founded and led by a former controller of the currency, Eugene Ludwig. And for our non-US viewers who are not familiar with the very convoluted structure of US financial regulation, the controller of the currency is the chief administrator of the US banking system. So this man knows how banking works. And what he has built is a platform. He has 5 partner banks, or sorry, 5 design partner banks. They're mid-sized regionals, important in that segment. And how it works is the following. They will send funds. So each bank, let me backtrack a bit. Each bank can issue a deposit token backed by a client's deposits. Only it's not a bank deposit token, it's a carry token. It's technically a deposit token, but managed by a third party. And then all the banks on that network can send carry tokens to each other as if they were sending traditional fiat to each other, only you have the additional features of 24/7, some programmability features, etc. And this solves the scale problem by inviting participants. The news that came out last week was that the bank now has 30 onboarded banks with another 40 in active discussions to join. That's considerable. Again, these are largely the mid-sized banks, not the huge ones, but they're the ones who need this kind of solution. I thought it was a fascinating take that deposit tokens, again, technology finds a way. If deposit tokens don't have liquidity, well, solutions will emerge for that.
Fascinating. I guess that's a good moment to pivot into this week's big read. As regular viewers know, but I will repeat for those who are first time viewers. We aim to take at least one big paper or book or something out there that is making people talk, and look at it very closely and read it from beginning to end on the basis and assumption that many people in journalism and the pundit space often comment on things without reading them properly. So our commitment, largely to help us also do the work, is that we will read stuff and we're taking it in turns. And this week, some of this is going to be tardy because naturally the stuff comes out last week, everyone comments on it. We actually read it. It takes us a bit of time to reflect. But I think it's worth revisiting. And in this case, the paper I wanted to read properly this week was a paper put out last week during the ECB Sintra gathering, which is the annual summer retreat of the European Central Bank. And it happens in Portugal. Lovely place, apparently. I've never been. The access to get there is very complicated. You have to apply. There are different tiers of access. And if you're a favored media outlet, do you get full access? Otherwise, you get sort of poor man's access, which means standing outside. And if you're lucky, you get to shake people's hands. That's about it. So I've never
Good
been.
scenery, though. You mean even
Sorry?
good scenery, though, even on the
Good
lower end.
scenery and usually hot, although weirdly not that hot last week compared to everywhere else. And everyone was there, including Kevin Walsh, and Bailey, all the big names. Now, one of the big sort of underappreciated stars in central banking, I believe, is Hyun Song Shin, who has always been a authoritative voice at the BIS, Bank for International Settlements. He's now gone on to become the governor of the Bank of Korea, and but I didn't think he'd just disappear off the grid. In fact, if anything, his presence, his profile is so large that he is bringing the Bank of Korea's profile into everything instead. So now he's put out a paper called Shaping Europe's Future Innovation Growth and Stability, Unified Ledger and Practice, Lessons from Project Hangang. The pronunciation here is no doubt terrible because I don't speak Korean. Beyond K-pop Demon Hunters, which is a different entire Korean
Such a good film.
phenomenon. Although it potentially has some links to unified ledgers, but I'll think about those parallels another time. So
Post incoming, right?
yes, exactly. So anyway, it's very geeky. It's all about kind of the practicalities of creating a unified single ledger, and they've had a go in Korea, largely because I think, they're not a G7 entity, so they can get away with a bit more uh, experimentation at a lower level. And they've done something called Project Hangang, which is named after the river that goes through Seoul, apparently. And the test case was really when you're creating a unified ledger, and by that they mean a system that will allow all these different newfangled concepts and tokenized, whether it's tokenized commercial money deposits, or whether it's tokenized assets, whether they can all interoperate with a central bank system that maintains the singleness of money across many different sort of operating frameworks and environments. And and immediately they because people have talked a lot, there's been so much written about it, but there hasn't actually been that much implementation. And a lot of the projects, especially the kind of DLT permissioned ledger projects, they too have been largely exercised in silos or in virtual sort of environments, whereas in this case they've actually implemented a test case, and it's been in a real world environment using 80,000 users, and I think 1,200 or yeah, 1,200, 12,000 merchants. So real test case, and the objective was to figure out what is the best way to go about it, because really, when central bankers get together, they realize they have two options in terms of how to take things forward. One option is to retain the current kind of system based on the classic RTGS structure, which uses a compendium of different kind of mechanisms to not just conduct payments, but also maintain monetary policy, liquidity. They have deferred net settlement, sometimes alongside the RTGS, to improve operational capability. A lot of these RTGSs are very specific. They all have different quirks. There isn't an international standard, largely because there is no international standard in terms of how central banks conduct monetary policy either. Like, everyone has a different sort of, flavor of toolkit. And like the PBOC is very different to, say, the BOE, which is very different to the Fed, which is different to the ECB. So creating a unified system that can interact with everything is very difficult. And the RTGSs have a lot of unique jurisdictional personality. So conventionally, they can kind of plug into different mechanisms, and the new updated RTGSs, that's one way to go about it. And so this paper is sort of figuring out, should we do that? Or should we just abandon the whole RTGS concept for this and move to effectively wholesale CBDC, what they call tokenized central bank money, but it's CBDC, and it looks at the sort of trade-offs between the two. And it's very geeky, but I really liked it because it talks about one of my most, pet sort of peeves, which is that sometimes these kind of liquidity fixes, or the concept that our tokenization or central bank ledgers, central bank distributed ledgers, can just magic instant atomic settlement out of nowhere. They overlook fundamental problems about how liquidity, behaves in practice, and how it is funded, and also how it can be effectively managed in an environment where lots of different RTGSs around the world are not interoperable at the same time, because we all, many of them close off for 4 hours a day, or they don't necessarily have timings that converge, which is when liquidity imbalances kind of amass, and that's when you often need some kind of bridging tool. And the bridging tool most often used is an overnight repo of some variety. But even before that, you have increasingly in the modern kind of super, instant settlement, instant transaction world, intraday imbalances growing everywhere. And that in itself is problematic. And one of the issues is that the RTGS systems are very much configured to deal with that, because they come with all sorts of mechanisms to provide intraday liquidity support to whenever there is any fear of gridlock, so-called gridlock, because that is one of the issues with any RTGS system, is that what you give up, and there are benefits in that you have instant settlement and finality. And that's great because it avoids what so-called Herstat risk, which was a notorious European bank that went down because of overnight exposure that sort of percolated back into itself. It was the last man in the chain in many respects, in a system that effectively, it was like musical chairs. You're not necessarily even responsible for the lack of liquidity. You might be a good bank, but you just end up without the chair at the wrong time. And this actually opened the door to so-called continued loop settlement in FX, because that was the only way to deal with it. So the upside of RTGS is that you shouldn't in theory get a Herstat risk, but the downside is that you get so-called congestion risk and gridlock risk, which is when if you get a single, it becomes very brittle. If you get even a moment where a payment doesn't go through, then the whole system, it gets systemically dangerous and the whole thing collapses. And to manage that, that's why you have to have intraday, you have to have basically a guarantor who can just flood the system with liquidity as and when it is needed to overcome this gridlock. And in many ways, I've argued that the response to 2008 was focused on dealing with this issue, because the injection of lots of kind of central bank reserves effectively created a lot of intraday flex, whereas there wasn't before. Intraday rates have completely, like, nobody borrows intraday anymore because of the massive abundance of liquidity that was created through QE. Whereas before 2008, banks were very, very dependent on intraday borrowing to overcome this, right? So now, as the central banks are pulling back that excess liquidity, intraday is suddenly front of mind for all central bankers, because the question is, how will we deal with managing that? And this paper basically just explains that if you're going to go down the tokenized central bank digital currency option, you're going to have an intraday liquidity sort of solution, and that in itself is kind of costly. So it's not a quick fix. And this idea that, like, simply going to atomic settlement, creating a interoperable ledger which can manage all sorts of different settlements, assets, and commercial money, that is not good enough. You will also have to have somebody capable of providing the intraday liquidity when it's needed, and that is likely to be the central bank. I mean, the conclusion is quite interesting. It says, I'll just read it out. Since intraday liquidity is currently provided on a collateralized basis, this isn't a conventional RTGS. Extending this framework to the new ledger environment would require additional system work, including modifications to the collateral management system, with a corresponding increase in the overall complexity of the system. This is a further consideration that needs to be taken into account. This is no small thing. Like adding a collateral management system, aka a guarantor who dispenses liquidity intraday against collateral, is incredibly complicated. An entire division of the ECB is dedicated to doing this on a daily basis, but not least because someone has to do the valuation of the collateral, which can be subjective, especially when you're the central bank propping up all the collateral. But that's another story. And then, where are we on time? And then I'll let you have some questions. The provision of intraday settlement liquidity poses a further challenge, as the tokenization of government bonds advances and settlement volumes on the DCS grow, ensuring an adequate supply of intraday liquidity liquidity becomes critical. In particular, if the wholesale CBDC is a representation of reserves held in the large value payment system, DCS liquidity must be funded and defunded through that system, where the operating hours of the two systems are asymmetric. DCS liquidity may become insufficient once the large value payment system has closed, since this would impair the full functioning of atomic DVP. There's a lot of jargon, I'll explain it in a second. On the DCS, it'll be necessary to consider mechanisms for supplying intraday liquidity directly to the DCS, such as intraday repo against tokenized government bonds, which is a long way of saying, basically, we're just going to have intraday repo, which, by the way, is something JP Morgan has been working on for a very long time. One of the first banks to really start engineering intraday repo on this sort of basis, which is no coincidence because they happen to be these days the what I call not the bank of last resort, but the bank of second last resort. Because before, when you're a bank and you're starved of cash intraday, before you even think about going to the Fed, you go to JP Morgan because it is the richest and most liquidity abundant, and is the one where all this liquidity amasses in the day, and then they just redistribute it amongst their clients to balance it off. That sounded like a lot of word salad. Maybe I just got very enthusiastic about this because I love intraday liquidity. Wonk. But Noelle, give me some questions.
So many. We're not going to have time to get to a fraction of them. I confess that most of that did go over my head. But one thing that was striking me as you were talking was if the collateral is on the same ledger, then part of the issue would not the issues would not be the same as with traditional RTTS, especially if the central bank has real-time visibility into where everything is at any given time.
It really depends because the issue of intraday isn't, it's to do with valuation, right? And so you can have all the tokenized assets available to you. The imposition is the actual act of like transacting that collateral against the right quota of liquidity and figuring out at what price, right? And so that in itself is, a question of, do you do it on some sort of administrative basis? Like you have a single rate that is, at the moment, many central banks just have a single rate as part of monetary policy, or you do it on some sort of haircut policy basis, or you have a sort of standing facility not a standing facility, but there is a big move in central banking, for example, to encourage the concept of pre-positioning of collateral, which means a lot of banks which have less liquid collateral, which they wouldn't usually want to use for liquidity operations, are preemptively kind of already put into the central bank system and valued, and all the due diligence is done. So the tokenization element isn't really the hard bit. It's the kind of associated sort of due diligence and the quality control and the valuations, and whether all the, just because it's been digitized doesn't take care of that. Garbage in, garbage out, So you still need, like, at the moment, I believe, at least this is what I was told, do correct me if you know better, that most of this sort of hard work for the ECB in the conventional system is done by the Bank of France, which has apparently some, this is what I was told. I might be lying, so I don't know, but apparently has some sort of large computer in its bowels where all these collaterals are kind of valued every day, or a lot of them. But again, that I might have been misled. So if you're a central banker and otherwise, let me know.
Absolutely.
But the point is, tokenization itself is not enough. It's simply it allows for like the digital.
Having everything on one ledger would again be convenient, but as you say, garbage in, garbage out, they'd still need to have a liquidity backstop, and if you're running two systems at the same time, that can get even more complex and potentially risky, right? Was he contemplating a scenario in which they would be running two systems?
Well, at the moment, yes, because changing the I know it sounds like a really easy thing to fix, but actually going from, say, a 20-hour operating framework to a 24-hour operating framework changes central banking to such a large degree that it's a very difficult shift to engineer. And so, largely because everything in liquidity pricing is configured around this sort of intraday, overnight, you know, 2 days, 3 days regime. And if you don't have the capacity to kind of price things on an overnight basis, carry them over, have these sort of pausing moments, you have to introduce a whole new configuration of, or rather a whole new system in terms of how liquidity is priced. And this is what I've been writing about for many years, is that I've suspected that if we inevitably go to a 24-hour regime, something more akin to a sort of Uber surge pricing model will have to be invented, because you won't have the kind of standard cutoffs that create those cutoffs in a way are like a system health check. It's like
Mhm.
every 20 hours we have to basically square the books and make sure everyone is good, so we don't, and if we have to carry anything over, there's a different price for it overnight relative to having the exposure intraday. But
Time to reset the market. Yeah.
if you get rid of that sort of health check, then you're either having to do the health check every 10 minutes, the way Bitcoin does it, or you have to do some sort of configuration where you get, um, like I said, a mechanism that allows for surge pricing, where if there's liquidity shortfall, there is a mechanism where you can draw on liquidity intraday, real time. But it requires such a massive kind of recrafting of the system that it wouldn't be easy. So in the interim, no doubt, for as long as RTGS operates, and it will operate for a long time, you will get this parallel world where your tokenized systems are 24-hour, but they still connect back to a system that bears this timing mismatch element. And
Yeah.
that's where all the risks kind of are now embedded. And this paper basically isolates this fact.
That is
Very
fascinating,
wonky.
especially given the froth that we have in the crypto industry, which is, core all bits are going to be tokenized and all money is going to move on chain. And you and I know that it actually isn't, because the disruption involved would be such. This is not like, moving a social media network or something. It's finance. It's global finance. There's a lot at stake here. And one thing the Bank of Korea has done before in the region, I haven't read this paper, but others I've read, are they're very conscious of their role in the region. And so any unified ledger, were they to develop one, would need to contemplate connecting to other unified ledgers in some of their key trading partners. And as we all know, unified ledgers connect to other ecosystems, and we know chain outages happen. And given the cascade of effects that you're talking about, that could be catastrophic in something as existential as global finance, without the health check that you mentioned of the let's just close business and reset.
Well, exactly. I think atomic settlement is nice in theory. And in theory, Bitcoin proves that you can have, to some degree, things, settling immediately. But what it overlooks is, Bitcoin is only one side of the ledger. You don't see what it's transacting against. Whereas what we're trying to build here is a unified system that is payments for collateral or payments for assets, right? So it's the other side of the ledger. So Bitcoin usually self-corrects when there's an imbalance through a massive volatility shock that adjusts through the price versus so effectively the volatility in the price kind of compensates for, the hard limit that it must settle today at this price. That's what makes it volatile. But in a system that's supposed to be stable and useful for monetary policy purposes, you can't afford to have that, because any gridlock where there's a sudden fall of liquidity would either result in, a massive collapse in the value of certain assets, or it would like it would reverberate on the price of the currency itself. And that is not conducive to a stable it's not conducive to financial stability, basically.
Not what a central
Um,
banker would, that's the stuff of central banker nightmares, right? And it's also a reminder, and I enjoyed this part, that friction can be our friend. We get excited about the potential for unified ledgers to harness ledger technology to bring together central bank money, commercial bank money, and assets on the same ledger. And how can we say no to that kind of efficiency? Until we realize that that kind of efficiency does in itself bring in some additional risks, and friction can help spot errors before they actually happen.
yeah, and I think the issue is to what degree is elasticity necessary in a system? And by elasticity, that I mean basically credit. And the way, like, let's face it, the way central banks deal with any clogging issues is by printing money, and they print money um, effectively at the cost of all of us because it's inflationary. So it's effectively a mechanism that taxes us for the maintenance of stability. But if they manage it well, it's only temporary, and then they in most cases, like, they charge for that liquidity, so the taxpayer isn't totally out of pocket, and if the entity they're lending it to is not insolvent, they will get that money back. So it's effectively tapping the tax purse when you need it, without any consequences, providing they make a good judgment about the entity that they are lending to. Now, if they make a bad judgment, the entity goes bust, then all of us bear the cost. It's like in real time, because that liquidity then really becomes inflationary.
Yeah.
So,
And the more interconnected the systems, the faster that risk spreads.
exactly, but this is the age-old sort of debate in between crypto and conventional fiat world,
Trade-offs.
whether this sort of printing for the sake of the system to keep it going is justifiable or not.
Yeah,
And
trade-offs.
yeah, exactly, and the central bankers would say it is definitely, because it allows for stability, whereas I think the kind of hardline perspective of the crypto universe is, no, better just go let the entity go bankrupt, right? And to be fair, like, I think they've proven that they can wear losses quite well. So that's the upside. In crypto world, you get almost bravery badges for how many crypto winters you've survived, and
Yeah.
there isn't that sort of stigma. But it's interesting. Anyway, so that is my contribution.
Yeah.
I've whittled on for a long time.
No, that was fascinating. Thank you for that. There again, I haven't read the paper. I'm going to, and there's going to be many things in there I just don't understand. So I may reach out to you for questions. But one thing we can take away from that is, one, that these new ideas are being explored at the highest level, even if and part of their job of the financial elite is to help us spot the risks. They are best positioned to see where the vulnerabilities could lie. And so that kind of exploration, even if he decides it's a bad idea, is very useful. It builds on the collective body of knowledge, and it shows that this is real. The finance is changing, and it's not a question of we're not going to pay attention to this, it's going to go away. It's a question of how can we incorporate these efficiencies into our systems without putting entire global finance at risk. There's a lot to unpack there also in terms of the interconnectivity between other systems, and we'll talk about that another time. But meanwhile, thank you, all of us, for joining us.
Oh, and I just want to add one last thing, because I remembered it right at the last minute, and I have to say it because it was so cute. Kyun Sun Shing has such a wonderful way with words, and he kind of, the proof of the conventional, like, um assessment of the system as proof of work or proof of stake, and he's put in a third one, which is proof of authority, which is effectively the central banking element. But anyway, sorry to interrupt, we're going now.
Yeah, no, actually, no, proof of authority also is something you talked about before. There are some blockchains that do actually run on proof of authority. In fact,
Well, there you
the Curry system that I was talking about earlier is an example of one of those. It's permissioned, blockchains. And of
Okay.
course, the central bank is going to go for permissioned blockchains. Now, it sounds like an excellent paper. The fact that he spent a lot of time on it, obviously with some help, is for me one of the big takeaways. These kind of papers may sound very dull, but they're not. And they're certainly not as frothy, and they're certainly not as antagonistic as the papers that we got in this industry for many years. They feel a lot more real. And especially for people like yourself, Izabella, who do love the plumbing side, for you to get a lot of takeaways from this, I think that's one of the biggest tells that this one is valuable.
On that note, it's definitely goodbye because my daughter's back from school.
Thank you all so much for joining us. Tune back in next week when we will, we'll hopefully get to grips with the technology even better than we did today. Great to see you all. And Isabella, thank you.
Take care. Bye.